Ever feel like the market has got a mind of its own? Well, guess what? There are puppet masters behind the scenes pulling the strings, and they are called central banks. Think of a central bank as the top dog of a country's money system. They're not your everyday bank. They're responsible for keeping the economy stable. And their favorite tool? Interest rates. Let's dive into why these rates are the ultimate wallet shakers and why you absolutely need to pay attention to them. And hey, drop a comment below. Which financial crisis had the biggest impact on your trading journey? So, what are interest rates? They're basically the cost of borrowing money. Central banks use them to manage a bunch of stuff. Like, for example, how much things cost, aka inflation. How easy it is for businesses and people to borrow, aka borrowing costs. And even how much a country's money is worth compared to others, aka currency value. But it wasn't always like this wild world of rate hikes and cuts. Back in the day, central banks were more focused on just making sure that there was enough money floating around and keeping things generally stable. Life was simple for those guys, but after some major economic meltdowns, they had to level up their game. Now, they actively control interest rates to keep things in check, and generally make sure that the financial system doesn't go totally bonkers. But what were those economic meltdowns, you ask? Well,
that's a great question.
One that requires a bit of a history lesson. You see, before the 80s, politicians often had a heavy hand in what central banks did, sometimes even pushing for lower rates right before elections to make things look good. And surprise, surprise, this often led to massive inflation spikes, causing everyday things to cost a fortune and leaving behind a generally unstable economy. But then came our hero, New Zealand in 1989, turning things around with inflation targeting. Basically meaning that the central bank publicly states a specific level of inflation that they're aiming for and then uses interest rates to try and hit that target. It was a game changer. Other countries were like, wait, that actually works? And jumped on the bandwagon. With this, central banks had now gained their independence, making decisions based on cold, hard data. No more political bullshit messing with the economy. Well, for a while at least. Then came the 90s, the era of the Great Moderation. Stable prices, solid growth, and fewer financial breakouts. The US Federal Reserve, otherwise known as the Fed, was being led by the legendary Alan Greenspan. And let me tell you, this guy was so on top of his stuff. He was reportedly looking at stuff like scrap metal prices to see if the economy was getting too hot. But even legends can have an oopsie-doopsie moment. In the 2000s, a housing boom went a little, wild. Banks started lending money like crazy, even to people who probably shouldn't have gotten loans. They then bundled these risky mortgages into investments that were sold as super safe.
No one is paying attention.
Talk about a ticking time bomb. And when the housing bubble finally burst, boom. Markets worldwide went into a tailspin, leading to the infamous 2008 financial crisis. After that, central banks were like, okay, maybe we need to be a little bit more hands-on with these interest rate stuff. Duh. And after that, things were very sluggish, so central banks started slashing rates. Some even went into the upside down with negative interest rates. Wait, negative interest rates?
Wait. What?
Yup. Banks were actually charged for keeping their extra cash at the central bank. The idea was to make them want to lend that money out instead, giving people more money to spend out in the world. Crazy, right? It was all an effort to get the economy moving again and stop people from hoarding cash like it was the last toilet paper roll in 2020. And speaking of toilet paper chaos, then came plot twist number 2, the COVID-19 pandemic. Cue stimulus checks and super low rates. While it helped initially to keep the economy above water, demand went through the roof, and guess what followed? Inflation. To get those prices back under control, central banks slammed on the brakes and aggressively hiked interest rates. This made their currencies stronger, but also caused some serious roller coaster rides in the markets. And with that, we reach the end of the crazy interest rates ups and downs. Well, for now at least. So, after all of that, you might still be asking yourself, how do these interest rate moves actually affect me directly? Well, They affect everything from how much you earn on your savings accounts to how much it costs to buy a house or a car. But just note that these changes take time, usually 3 to 9 months, to really ripple through the economy. That's why central banks are obsessed with forecasts and data and trying to predict the future like financial money-minded fortune tellers. What's insane is that even a hint that rates might change can send markets into a frenzy. If rates are expected to go up, a country's currency often gets stronger, but stocks might take a hit. If rates are likely to go down, stocks might get a boost, but currencies could weaken. It's like a financial seesaw. So, can you actually make money with all this interest rate drama? Absolutely. That's why knowing all of this is so important. Understanding what central banks are doing and why is crucial for any serious trader. And if you want to stay ahead of the curve and trade like a pro, keep an eye on those central bank announcements, follow our events calendar, and maybe check out what industry leaders like FxPro are up to. Don't forget to like and subscribe for more market insights. Till next time, traders.